Hi everyone, it's Matt Barnes here and welcome to part 2 of our FX trading series. In this video, we're going to be talking about the components of an FX trade. So unlike stocks, there are a few extra little bits and pieces when it comes to trading in the FX market. So I'm going to break all of those down for you bit by bit. And by the time you've gone through this second video, you'll actually be able to go ahead and take an FX trade and you'll understand all of the components. Obviously, there are 5 more parts in the series. We're going to be looking at an actual live trade taken in a demo account so you can see all of the pieces working in action. We'll talk about account management, position sizing to make sure that you don't go and take positions that are too large and are going to put your account in danger. We're going to be looking at technical and fundamental analysis. We'll look at historical trades and setting yourself up for a trade. So there's plenty still to come, but by the end of this second video, you should be able to get in there and take an FX trade with a good level of confidence. If you haven't already done so, please click on the subscribe button below this video to subscribe to our channel and keep up to date with all of our future videos as they come out, including the remaining videos in this series. Now, as I said, this is the second in the series. Please make sure that you've watched part 1 before you continue because the videos do continue on from each other. In this lesson, in part 2, we're going to be looking at the topic of what currencies can I trade? We're going to look at going long and going short. We'll look at the bid-ask spread, which can be a little bit confusing to new traders, particularly in the FX market. Which of these prices do I trade at? We'll talk a little bit about position size and how we determine that. We'll talk about the concept of margin and how much money you need to have for a trade. We'll look at tick size and tick value. And really, this is one of the harder points in FX. If you can get this part right and work out what a tick size is and how much it's worth, you'll find most of the rest of FX to be pretty easy. This is the part where some currencies will have 2 decimal points, some will have 4, and it gets a little bit confusing if you've never traded them before. Once you do a few trades, you'll realize it's just as easy whether there are 2 decimal places, 3 decimal places, or 4 decimal places. It really doesn't matter. We'll also talk about financing. When you're trading a CFD, for example, on stocks, many of you would be familiar with the concept of financing. Well, in the FX markets, not only is there financing, but there are 2 interest rates that you have to deal with. So we'll look at that as well. The final thing that we'll talk about is calculating risk and reward on the trade to make sure that we're not over trading. You'll see on our other YouTube videos, WD Gann actually talks about the 3 reasons traders lose money from the markets. And one of those reasons is that they overtrade. They risk too much on a trade. And that's a common way that people lose a lot of money in the markets. And it's money that they shouldn't lose in the market. So getting that risk and reward or those risk and reward calculations correct is a really important thing. Okay, so as you can see, it's a little bit of a packed session. So settle down with a glass of water or a cup of tea and a pen and paper, and let's get started. So let's talk about which currencies can I trade? Well, the answer is pretty much all of them. Okay, if you can think of a currency, you can probably trade it. I use Profit Source trading software, and it's got over 100 pairs to choose from alone. That doesn't mean that I trade all of them. I tend to stick to the majors, but there are loads out there that you can trade. There's all sorts of combinations. When you talk about major currency pairs, that's normally a major pair like the euro, the yen, the pound, etc., traded against the US dollar. Whenever you hear major, you'll see the US dollar as one of the currencies involved there. We'll talk a little bit later, and I already mentioned it in video 1, that there are always 2 currencies involved in every single FX trade. So in the majors, the US dollar is always one of those 2 currencies. The majors are the most liquid. Having said that, you can still trade other pairs like the cross-currency pairs, for example. Cross-currency pairs or crosses are where you've got 2 currencies and the US dollar isn't one of them. So you've got majors and you've got crosses. The crosses are a little bit less liquid. Obviously, that's the same if you were trading some of the biggest stocks on the US stock market, for example. When you start trading the smaller stocks, obviously there's going to be a little bit less volume in most of them, but they're still tradable for the most part, and that's certainly the case with currencies. So let's talk about the majors. You've got the euro against the US dollar, the US dollar against the Japanese yen, the British pound against the US dollar, the Australian dollar against the US dollar against the Swiss franc, and the US dollar against the Canadian dollar. Now, Over the years, starting from 2005 when I first started looking at currencies and right up to this time of recording in 2018, I always hear different numbers for the majors. People will say there are 4 major currency pairs. People will say there are 6 major currency pairs, which are these 6 that you see here. And people will say there are 8 major pairs, and they'll include the New Zealand dollar and the South African rand. There are loads of currencies out there. Don't get too bogged down in whether something is major or not. The way that I determine whether I'm going to trade something is that I'll open up a chart in my trading software and I'll have a look at the ranges, make sure there are no gaps, as we spoke about in the last video, and just make sure that the bid-ask spread is not too wide, which we're going to have a look at in this video. Okay, so I want to talk about this notion now of currency number 1 and currency number 2. As we've discussed, there are always 2 currencies involved in an FX trade. So when you hear them say on the news, the Australian dollar is trading at 73 US cents, there are the 2 currencies involved. You've got the Australian dollar and the US dollar. They don't say one Australian dollar buys 1 apple or half an apple or a quarter of an apple, with inflation, but it's always one currency against another currency. So you'll hear terms such as base currency and the terms currency or the quote currency. So the base currency is what I call currency 1. The terms currency is what I call currency number 2. I call them currency 1 and 2. I just find it easier to remember. I used to try and think in terms of base currency and terms, got a little bit confused. And in the end, I just read them from a left to right order. So if we're looking at the euro versus the US dollar currency pair, or the euro US, the euro would be currency number 1 and the US dollar would be currency number 2. Right? And it is important to understand which one is currency 1, which one is currency 2, because as you're going to see in a moment, your position size and your margin are denominated in currency 1, but then your profit or loss is actually denominated in currency number 2. So if you're trading the euro US dollar, your position size is going to be in euros and your margin is going to be calculated in euros, but your profit and loss is going to be calculated in US dollars. Again, it might seem a little bit confusing, but once you've taken 2 or 3 trades, you'll realize there's not much to it. It's fairly straightforward. I'll throw a third point in. If your trading account is denominated in Australian dollars, or if you're trading the euro US dollar, basically if it's denominated in any currency that is not the euro and not the US, not US dollars, your profits and losses will need to be converted at some stage into your native currency, or the currency that your trading account is denominated in. So if I'm here in Australia, which I am, and I'm trading the euro against the US dollar, my profits are going to be calculated in US dollars, but they're going to be transferred or converted rather back into Australian dollars at the time that I close the trade. So that actually brings in a third currency, but I'm going to talk about that a little bit later. So let's talk about this as currency 1, currency 2. In October of 2018, 1 Australian dollar will buy you 0.7140 US dollars, which you can say is just 71.4 US cents. It'll buy you 1.0840 New Zealand dollars, or $1.08 New Zealand, 80.15 Japanese yen. Okay, so you can see that obviously there's a bit of a discrepancy there with the size of the yen. The yen is a lot larger. If you were actually transferring money or converting money, 10,000 Australian dollars would buy you 7,140 US dollars. And the easy way to do this is to just move the decimal places. You can see higher up on the slide at 0.7140 US dollars. What you can actually do is just move that decimal place. There are 4 zeros in $10,000, so you move the decimal place 4 places to the right. So that just becomes 7140 US dollars. Okay, so 10,000 Australian dollars will buy you 7,140 US dollars. It will buy you 10,840 New Zealand dollars. Again, we just move that decimal place 4 places along. And 10,000 Australian dollars will buy you 801,500 Japanese yen. Okay, again, we just move that decimal place to the right by 4 points. It reminds me of a Seinfeld episode where Kramer is taking some Japanese businessmen around and he sees that they've got hundreds and hundreds of thousands of yen and he thinks they're rich. So he blows all their money really quickly on buying silly things because he thinks they can afford it because they've got lots of yen. But I digress. Okay, this is a chart that I put together for safety in the market students using Profit Source. So these are the codes that are in Profit Source if you are using Profit Source software. So you can see over here, every code has 6 letters, and this is just for Profit Source software. You'll have to look this up in your own trading software, but you can see FX, AD, US. So FX is obviously short for foreign exchange, or FX, and then you've got a 2-letter code in Profit Source for currency 1 and a 2-letter code for currency 2. A lot of broking platforms or other software will just use another 6-letter code, but it will be AUD, USD, for example. Australian dollar, US dollar. So make sure you're familiar with the codes before you jump into the market and start trading. So in this case, if you're trading Aussie dollar, US dollar, you'll see that currency number 1 is Aussie dollar. Why is the Aussie dollar currency 1? It's because the currency is listed first. If you flip them around and you put US dollar first and Aussie dollar second, you can still trade that pair or trade it in that way, but it will be a different number because this way it tells you 1 Aussie dollar buys X number of US dollars, whereas the other way it will say 1 US dollar buys X number of Australian dollars. All right. So currency 1 Aussie dollars, currency 2 US dollars. Now for a $10,000 position size, the margin using 1% as a margin rate, the margin would be 100 Australian dollars. Okay, because that's currency number 1. Actually, these days, brokers will let you use margin of 0.5% or even 1/4%, but I've just stuck with the 1% here because that's a little bit easier to calculate. And some brokers do still ask for 1% margin, but most of them ask for less now on the major currency pairs. The tick size on the Aussie dollar, US dollar is actually 0.0001. So there's those 4 decimal places we spoke about in part 1, and that's something that can throw people out a little bit. It's really not that hard, as we'll see when we do some calculations. One thing that was a little bit hard for me starting out was working out why my tick value was in US dollars. So if my margin is in Australian dollars and my position size is in Australian dollars, why is my tick value in US dollars? Well, I'm going to show you a calculation shortly that's going to explain that for you. All right, it's a good idea for you to create a little table like this for yourself using either your own trading software if you're not using Profit Source or using your broker's platform, for example. And if you're not sure what these are, just sit down with your broker. Brokers, people have this idea that brokers are scary. Brokers love clients. They love you because every time you trade, they make a little bit of money. And if they can get you to the point where you're an independent trader, you're going to be trading and they don't even have to talk to you, but they're going to be making money from you. So a good broker is going to be happy to invest a little bit of time to help you out and to get you started with this stuff. If you create a little table like this, maybe using either a piece of paper or something like an Excel spreadsheet, just fill this in and just check it with your broker and say, right, so if I trade 10,000 Canadian dollar, US dollar, for example, or if I trade 10,000 US dollar Japanese yen. Can you just confirm what my margin would be and how much would the tick value be? It will only take them a couple of minutes to take you through this. And once you've got it there, you'll be ready to go moving forward. So you only have to do it once. Okay, but get something like this. It'll make your life a lot easier. Okay, so with that in mind, let's talk about the concept of going long and going short. If you're trading in the stock market, you buy a stock, you make money as that stock goes up. We say that you have a long position in that stock. So if you buy 1,000 shares of Microsoft, we say you have a long position in Microsoft or you're long Microsoft. That's the terminology that we use. And then if you short sell a stock, you make money as that stock falls. Obviously, we say you have a short position. Now, if you're not familiar with short selling of stocks, Safety in the Market students, you can just check out your appendixes, Appendix A in your Active Trader program. In the first half of that, which is the Smarter Starter Pack, you can get in there and just double check any of your short selling details there. But that's the difference between being long or short in the stock market. You're either long the stock or you are short of the stock. In FX trading, you're always buying one currency and selling the other currency. Okay, so remember there's always 2 currencies involved and you're always buying one of them and selling another one of them or selling the other one. Okay, so let's look at an example. Let's say that the Aussie dollar US dollar currency pair is trading at 0.7140. That means 1 Australian dollar will buy you 71.4 US cents, or it will buy you 0.7140 US dollars. For the rest of this presentation, I'm just going to read these out as I read them out to myself when I'm doing my analysis. I just treat this as 7140. I just pretend there's no decimal place. I just pretend that it's a stock or an index trading at 7140, and then each point just 7141, 7142. Each tick is just 1 point, and that works for me. It makes it really easy to do calculations. After a while, you get sick of typing 0 point on your calculator, and you realize that if you're doing 0.7140 and say 0.7000, you don't actually need that 0 dot. So you're actually saving the 0 key and the point key on your calculator from wearing out too early. So feel free to drop that decimal place if it makes it easier for you to do the calculations. So let's say the Aussie US dollar is trading at 71.40 and you buy a position. You want to go long, or you want to make money as this Aussie dollar US pair goes up. So you buy 10,000 of AUD/USD at 71.40. What you're actually doing in this transaction is you're buying currency one, so you're buying Aussie dollars, and you're selling US dollars. So we're buying 10,000 Aussie dollars. If we're selling US dollars, have a think about how many US dollars we're selling. We're actually selling 7,140 US dollars. Right. Another way of thinking about this is you're actually borrowing in US dollars to invest in Australian dollars. Okay, and that will factor in when we do the interest rate a little bit later. But that's what's actually happening in this transaction. You're buying Aussie dollars, 10,000 of them, and you're selling 7,140 US dollars. So we're actually long Aussie dollar, US dollar. We don't say we're long the Australian dollar and we're short the US dollar. You can say that, but it's a bit clunky. We just say we are long Aussie dollar, US dollar, or we're long the Aussie dollar. If you hang around the currency markets long enough, you'll realize that when people say, you're long the Aussie dollar, it's generally against the US dollar unless they specify otherwise. Okay. Now, because we're long Aussie dollar, US dollar, if the Aussie dollar, US dollar goes up, you're going to make money. Okay, but we're going to explore that a little bit later with some calculations. So when I talk about being long a currency pair, I'm actually talking about buying the first currency or currency number one and selling the second currency. Okay, so again, it's not too much harder than stocks. It's just a little adjustment that you need to be aware of. When you actually get in there, and as we'll see in part 3 in the next video, you'll see that when you actually get in there and you just click buy 10,000 Aussie dollar, US dollar, bang, it all happens instantly. You don't have to think about any of this. You buy your 10,000 or however many you decide to buy. You make money as it goes up, and it's pretty straightforward. Okay, but we're going to break that down a little bit later on. So as I said, I'm just going through all of the components in this video, and in later videos we will be putting them all together and taking some trades and looking at some other things like history and analysis. Next up, we need to look at the bid-ask spread. So let's assume you're ready to trade. You've done your analysis. You've watched your FX trading videos. You open up your broker's platform, and what do you see? You see two prices. You think, well, hang on a minute, I want to buy Aussie dollar, US dollar, and you're giving me two prices. You might see Aussie dollar, US dollar trading at 0.7140 / 0.7141. So it's either trading at 71.40 or 71.41. Which one do you trade at? Well, it's an easy one. You might not like the answer, but it is an easy one. The answer is you trade at the worst one. Okay. Let's think about this for a moment. If you want to buy Aussie dollar, US dollar, which one would you prefer to buy? Would you prefer to pay 71.40 or 71.41? I mean, it's a bit like going to buy a new car, and they say, would you like to pay $6,000 or would you like to pay $6,001? I'm not sure why I chose that example. Not sure where you can buy a new car for $6,000, but you get the point. Which one is the worst one? The higher price is the worst one to buy at. So let's assume that you could trade at the best price. Let's say that you could buy at 71.40. You could jump into the platform and you go bang, you buy at 71.40. And then immediately you can sell at the other price, 71.41. Okay, you would make a point straight away, instantaneously, and straight away, well, that's not going to work. If that's how you could do that, nobody would have jobs. Everyone would just be in there going bang, buy at 71.40, sell at 71.41. Okay, so When you buy at the higher price, which is 71.41, and you sell at the lower price, which is 71.40. Okay, and that's partly how the brokers make money, by the way, because of that spread, which I'll talk about in a moment. So the number on the left, 71.40, is often referred to as the bid, and that's how much buyers are prepared to pay for that currency. And then on the right-hand side, that is the ask or the offer. But if you think about ask, that's what sellers are asking for when they want to sell their Aussie dollars. They want 71.41, right? So your bid on the left, that's the highest price buyers want to pay, and the ask on the right is the lowest price that sellers want to sell at. And somewhere in the middle there's your spread, and that will move around a little bit depending on the time of day and the liquidity. But obviously, there is a natural spread between what buyers and sellers want to pay, and most brokers will add a little bit of extra spread on just so that's where they make their money. We'll talk about that in a sec. Okay, so again, if the Aussie dollar US dollar is trading at 71.40/71.41, it means there's a spread of 0.0001 points. And the spread is a cost of trading. You'll often hear brokers advertise themselves, FX brokers advertise themselves as no commission or zero commission. And that's true. They won't charge you any brokerage. But when you trade these spreads, people think, oh, well, there's always going to be a bid-ask spread anyway, so I'm trading FX for free. No, the broker's actually taking a cut of that spread. So the spread will be a little bit wider, and that's how they're going to make their money. Okay, so again, imagine you jump into this market straight away and you buy at 71.41. Okay, remember the worst price is where you're going to buy. You can immediately sell that position at 71.40, but you would lose 1 point in doing so. Again, that 1 point is the spread, and that's how brokers make money. For a long time, FX markets like the Aussie dollar against the US dollar traded to 4 decimal places. These days, a lot of brokers, probably most brokers, will now include a 5th decimal place. So you'll see something like 71.40 and then a little 2 on the end, or a 3 or a 5 or a 7 or a 9. And the reason that they do that is they can offer a tighter spread. So rather than offer you 71.40/71.41, they might offer you 71.40 and then a little 2, so as the 5th decimal place, and then 71.40 with, say, an 8 as the last decimal place. So it'll be a 0.00006 spread. Okay, so it gets really, really tiny. I've got to be honest, I just ignore that 5th decimal place. I do all my calculations to 4 decimal places. That 5th decimal place, which we'll see in an example a little bit later on, that 5th decimal place is actually really, really tiny. It's worth 10 cents per $10,000 position. It's really not worth worrying about it. You might say, but what about perfectionism and making sure that you do the exact calculation to the point? You're going to see as we go through these components, it's very hard to know precisely to 4 decimal places or 5 decimal places, or really to 2 decimal places. We're talking about profit and loss here. But it's very hard to know before you take an FX trade what your exact risk and exact reward are going to be. And I'll explain this as we go, but basically, when you get into a trade, you might be trading the euro against the US dollar, and it might move in your favor, but then when you get your profits in US dollars, you've got to convert them into your native currency. And you don't know what your native currency pair, so maybe the Aussie dollar, US dollar, you don't know what it's going to do. Is it going to get weaker or stronger? So you can't actually calculate the exact point. You can get close, but you can't calculate the exact point. Similarly, you don't know exactly how many days you're going to be in a trade. So when you're paying interest, you don't know exactly how much you're going to be paying or whether that rate might change while you're in the trade, for example. Again, if you want to know how long you're going to be in a trade, you can bring in some things like time analysis from Safety of the Markets Ultimate GAN course, but you're not going to know exactly every little element of the trade, like the interest. Is the interest going to change? What if you're in for an extra day or two, etc. So that's why I'm not so concerned about that 5th decimal place, because there are already other variables, which mean it's basically impossible for me to know exactly what my risk is. It might be 500, it might be 520 or 515. So it's just going to be a little bit out either way. It's not much, but it's just not worth getting pedantic to the final 1 cent about. Okay. Again, that's my how I trade FX. I think there's enough to worry about in markets without that 5th decimal place. If you want to go down that route and calculate the fifth decimal place, by all means do that. All right, let's talk about position size now. Position size is denominated in currency number one. So if you're trading a position in the Aussie dollar against the US dollar, it's going to be denominated in Australian dollars. If you're buying $10,000 or a $10,000 position, you are buying 10,000 Australian dollars and you're selling X number of US dollars at the same time in order to enter the position. Okay. Now, why have I said X number of US dollars? Because I haven't given you the exchange rate. As that exchange rate changes, the X number of US dollars that you're selling to enter the position is going to be changing as well. All right. Now, here's where it gets a little bit tricky, just for a moment. When you want to close the position, you sell 10,000 Aussie dollars and you buy Y number of US dollars to close that position. Okay. Now, looking at this, you can see that we're buying 10,000 Aussie dollars to enter. We're selling 10,000 Aussie dollars to close. So they actually cancel each other out. Okay. But when it comes to US dollars, you'll see that when you're entering the position, you're selling X number of US dollars. And again, that's determined by the exchange rate at the time you enter. When you're closing the position, unless you're entering at exactly the same price, you're selling a different number of US dollars. You're selling Y US dollars. So what you end up with is the buying and selling of 10,000 Aussie dollars cancels each other out, but the X and Y US dollars don't cancel each other out. One will be positive, one will be negative, and you'll have a leftover position in US dollars, and that's your profit or loss on the trade. Okay, that's why your profit or loss is denominated in currency number two, because currency number one is stable, it stays the same. Okay, so currency one, just remember that the Aussie dollar amounts in this case, currency one amounts remain constant. Currency two amounts will fluctuate. As I said, unless you get out at the exact same price that you got in, there will be a different amount for currency number two. All right. Now, further with position size, when we're calculating position size, let's sidetrack for a moment. Let's imagine you want to buy $1 million house. Okay. How much deposit do you think you would need to buy $1 million house? Well, 20% deposit is a number that gets thrown around a lot. That would be $200,000. You want to buy a $1 million house, you've got a $200,000 house, and you're going to need to make repayments on that over 30 years. Okay. If you have mortgage insurance, you might be able to get that deposit down to 5%, for example, and only put up $50,000 deposit. But you're still going to have to make repayments on that loan as time goes on over 25 to 30 years. If you want to take a $1 million long position in the Australian dollar, US dollar, you only need a 0.5% deposit, which is 5,000 Aussie dollars. So $5,000 will get you a $1 million position in the FX market. And there's no mortgage insurance, and there are no repayments either. Okay. There will be an interest component depending on interest rates, which we'll talk about a little bit later, but you don't have to make principal repayments. You can hold that long position as long as you like without having to pay off that $1 million. All right, so a little bit of a difference there, isn't there, with the flexibility of FX trading and that enormous leverage that you've got at your disposal there. As we'll see as we go a little bit further into this video, that's a really good thing, but it can also be a really bad thing if you don't treat it with respect. Okay, that's why when we talk about risk and reward later on, I do it very thoroughly, and I make sure that you understand each part of that to make sure that you don't take any silly risks. Can you imagine if you've got 5,000 Australian dollars in your account, you can just pop it into an FX trading account and buy $1 million worth of Aussie dollar, US dollars straight up. No one's going to check your income or your assets or whether you can do that. You can just jump straight into $1 million position, no questions asked. What's the problem with that? Well, the problem with that is we're going to talk about that up next. That's going to be margin, and you can get a margin call, but we'll come back to that in just a moment. Okay, a little bit more on position size first. As I discussed in video number 1, you can actually set your own position in the FX markets with a little bit more ease than you can in futures contracts. Futures contracts, like if you were trading the Australian dollar against the US dollar using futures contracts, you have to trade in $100,000 lot sizes. Now, when you've been trading FX for a little while, 100,000 is not a big lot size. It's pretty small, but it's not as flexible. If you want to take a risk on a trade of a particular amount of money, if you have that risk set in mind, which is how I recommend you do it, you take your trades with a similar amount of risk on each of them. If you want to take, say, a $100,000 position, you can do that easily in either futures or FX, no problem. If you want to take a $200,000 position, you can do that easily in futures or FX, no problem. But if you want to take a $130,000 position or a $150,000 position or a $170,000 position, you can't do that using futures. So you either have to take a risk that's larger or smaller than you want it to be. In the FX market, you can actually set your position sizes in $10,000 increments. So you've got a lot more flexibility to have the same dollar amount of risk on your trade. You can fine tune that a lot more easily using FX than you can with futures. And in fact, there are some brokers that will let you do $1,000 increments. Okay. But however, remember that just because you can take large amounts doesn't mean that you should take large amounts. Position size, when you're determining how much to trade, should be calculated using risk, not how much you can trade, but how much you want to risk. Okay, and we're going to discuss that shortly. Before we get there though, I want to talk about the margin or the deposit. We've just seen that you can get into $1 million position with 0.5% of that position, or $5,000. Okay, no legals, no stamp duty, no loan application fees, nothing. Just bam, straight in, you're in $1 million position. Okay. What's the downside? The downside is margin. Margin is actually an upside if you think about it. It's protecting you from taking trades that are going to wipe out your account. But margin is the deposit that's required to be in the trade. As we said, it's like your 5 or 20% home deposit, and $5,000 will control $1 million Australian dollar, US dollar. When you're trading the cross-currency pairs, brokers won't necessarily give you 0.5% leverage. They may give you 1% or 2% leverage. So you have to put a little bit more money in. You can't take as large a position size. Brokers give you such large leverage on the major currency pairs because they are just so liquid, and the brokers feel that they can get out of those positions straight away if you have a margin call, so they're not putting themselves at too much risk. Okay, but with margin, there is a catch. And the catch is what's known as a margin call. If you follow the example that I just gave you, if you put $5,000 into your account, yes, you can open a $1 million Australian dollar, US dollar position straight away, no problem. You can do it in 5 seconds. Okay, but you put yourself at risk of a margin call. If that trade moves against you and the value of your account falls below $5,000, remember that's exactly what you have in the account. If the value of the account falls below $5,000, you're going to get a margin call. And a margin call is where your broker rings you up and says, hey, such and such, I've just noticed that your account balance has fallen below the amount of margin that you require. Please do one of two things. Please deposit more money into your account, or close part or all of your position, or positions if you're trading more than one thing. Okay, that's what a margin call is. WD Gann actually gives some good advice on margin calls. Check out our Wisdom of WD Gann section of the YouTube channel to explore a little bit more the world of margin calls. But basically, those are your two options: deposit more money or close part or all of your position. And neither of those are really things that we want to do. You don't really want to deposit more money into your trading account. If you wanted to have more money in your trading account, most of the time, most people would put it in there in the first place. Okay, so it's not in there for a reason. So you don't want to have to deposit more money. The second thing you can do is to close part or all of your position, but I'm sure you can see the problem there. Okay, the problem is you don't want to close part of your position because it's in a loss. You probably still think that the trade's going to go in your favor, and it might, but if you close part or all of your position now, it's going to be at a loss if you think about it, because you're getting a margin call because your account's gone down in value because the trade has moved against you. Okay, so that's neither of those reasons, neither of those things. We don't want to take either of those. They're unfavorable actions. So we're going to talk about risk and position size calculations a little bit later. And if you do it properly, if you follow the rules, you should never, ever receive a margin call. Okay, if you receive a margin call, it means that you're over trading. Okay, and that's not a good thing. All right, so margin is denominated in currency number 1, and it's based on a percentage of your position size. So you remember we said that your position size, if you are taking a position, say 10,000 Aussie dollar US dollars, what you're actually doing is a $10,000 Australian dollar position size. So your position size is based on currency one, and your margin is based on your position size. Therefore, your margin is going to be denominated in currency number one as well. It's generally 0.5% margin for the majors and a little bit higher for the cross-currency pairs. But you should always check with your broker, because brokers are well within their right. They can jump that margin up from 0.5% to 1% or 2%, or even 5%, for example. They can do whatever they like. There's no law that says the margin must be this or that. Okay. If you read some of Gann's work, it's very interesting to note that in the lead up to the 1929 crash, margins were very low, and when margins were low, people can buy very large positions compared to the deposit they put up, and it's no surprise that we actually saw a huge bull market during that time, because people could go in and buy stocks. And then, interestingly, after the 1929 crash and the big bear market and the Great Depression, once all that unfolded, regulators came in and said, well, what are some things that we can do to stop these kind of runaway moves from happening? And they raised margins. And it's interesting that there wasn't a major crash, anything like the 1929 crash, for a long time, until we hit the 80s, and somebody decided that they'd lower margin percentages again. So isn't that interesting? Margin, just because it's available, humans tend to take advantage of it, but you can see where that leads to market booms and busts, and it contributes to that. So just keep in mind, brokers can change it. There's no laws for what they can do with FX, although I know they are trying to clamp down on that a little bit, which is probably not a bad idea. But check with your broker before you take a trade, because they can change that margin on you. Now, as I've already said, you should never, ever, ever receive a margin call when you're trading FX. If you get a margin call and you're trading FX, it means that you're over trading, which means you have too many positions on, or you're taking positions that are too large for your capital, right? And there are some good rules that David Bowden lays down in the Active Trader program for this. And David says, never have more than 30% of your account tied up in margin on any one trade. Okay, so if you have a $10,000 account and you're trading, say, the Australian dollar against the US dollar, don't tie up more than 30% of your $10,000 in any one trade. So don't use more than 3 of that 10,000 on any one trade. David goes one step further and says, never have more than 50% of your account tied up in margin at any one time. So people will say, oh, I don't want more than 30% of my account in margin on one trade, but I'll take put 25% of my account in margin on the Aussie dollar, 25% on the euro, 25% on the pound, and then your account's all margined up. He gives you the 2 specific things there. No more than 30 in any one trade or any one market or any one currency pair, and no more than 50% in margin in total. Even if you've got 50 trades on at 1% each, don't go to 51%. And I think they're pretty good rules. They're straight from David, straight out of the Active Trader program. All right, so we've spoken about position sizing and we've spoken about margin, and you've seen the relationship between position size and margin, and how margin is a percentage of your position size, so they're going to be in the same currency. The next thing that we're going to talk about now is tick size, and tick size is the smallest amount that a currency pair can move. So if you're watching the Australian dollar against the US dollar, it doesn't just jump from 71 cents to 72 cents like a stock would. In stocks, 1 cent is what's called the tick size for most stocks. It's the minimum amount that a stock can move. So a stock might go from $10.05 to $10.06. That's its minimum amount that it moves. In the currency markets, it's a little bit different. The Aussie dollar US dollar moves in 4 decimal place increments. So it will move from 0.7100 to 0.7101. Okay, so with that in mind, we say that 0.0001 is the tick size for the Australian dollar. That's how it moves. That's its minimum fluctuation. When it's going to move, it moves in 0.0001 increments. If you look at something like the US dollar Japanese yen, the tick size is 0.01. Now, we saw earlier that the US dollar Japanese yen trading at about the Australian dollar Japanese yen trading at about 80. So one Aussie dollar buys about 80 Japanese yen, but one Aussie dollar only buys about 71 US dollars, or 71 US cents rather. Okay, so you can see that the numbers that we're dealing with in the yen are much larger. That's why the tick size is 0.01. It's 1/100th or 100 times larger rather than the tick size on the Aussie dollar, US dollar, and that accounts for the different sizes in the currencies there. Okay, generally speaking, most currencies will trade to 0.0001. So when you're looking at the majors, most of them will trade to that, unless, as we see with the US dollar, Japanese yen, unless there's the Japanese yen involved. When the Japanese yen is involved, it's generally 0.01, so just the 2 decimal places. There are ways of calculating what it should be, and we'll see that. Obviously, the easiest way is to just check this with your broker before you trade and create a little table like I showed you earlier. Okay. As I just was saying, one US dollar buys around 115 yen. That's why there's just the 2 decimal places there. In actual fact, when you're looking at currency pairs, if one US dollar buys 0 point something, it will normally be to 4 decimal places. If one US dollar buys 1 or 2 point something, it's still usually in 4 decimal places. However, when one US dollar buys 10 or more of something, that's where you normally see that flick over from 4 decimal places to 2 decimal places. Okay, it's not something that you really need to worry about. It'll just be at an individual case basis, and usually with the Japanese yen. Okay, now, as I said earlier, most brokers now quote an extra decimal place, which means the Aussie dollar, US dollar will be shown as 5 decimal places, and the US dollar yen will be shown as 3 decimal places. The difference that we're talking about, for every $10,000 position, that extra decimal place adds up to about 10 cents per point. Okay, it's really not much. It's really not worth worrying about. And as I said earlier, I just generally ignore it because of the fact that I can't. If I could get every other piece of the puzzle precise and to the point, I would make the effort to focus on that extra decimal place, but I can't. And when I do my calculations, maybe it's force of habit. I just use the 4 decimal places. It's really not that big a deal. Okay, so I generally ignore it. If you want to do it, it's just a matter of typing in the 5 numbers into your calculator instead of the 4 numbers. Okay, so we've spoken about tick size. We know that the Aussie dollar moves to 4 or 5 decimal places, and the US dollar yen moves to either 2 or 3 decimal places. Okay, what's it all worth? Well, the tick value is the value of a 1 tick move. That's what we need to calculate, and it's always calculated or denominated in terms of currency number 2. If you're trading a futures contract, they're all set positions, and the tick value per contract will always be the same. So you can just look and it will tell you, one futures contract, the tick size is $6.25 per point or $12.50 per point, for example, and that's fine. In the FX markets, however, your position sizes, you can construct whatever size you like, and it moves in $10,000 increments. And as a general rule, a $10,000 position in currency number 1 is going to result in a profit or loss of $1 or 1 unit in currency number 2 per tick. All right. Now, that's a mouthful, and that's actually an edited sentence. I tried to bring that down as small as I could, but a 10,000 unit or $10,000 position based in currency number 1 generally results in as long as you're not dealing with the yen, it generally results in a profit or loss of $1 or 1 unit in currency 2 per tick. Okay, so come back to the position that we looked at earlier, or the table that we looked at earlier, and you can see that if we're trading a 10,000 Aussie dollar position, the tick value is 1 US dollar. 10,000 British pounds, 1 US dollar, 1 US dollar, 1 US dollar, 100 yen when you're dealing with the yen, or the Aussie yen, 100 yen. Otherwise, 1 unit, 1 unit, 1 unit. Okay, so that's pretty straightforward. You'll get used to that as you go. And when you work that out, it's then just a matter of working out how much you're risking on a trade for a $10,000 position. And then you just keep multiplying that out until you work out the position size that you want to take. But I'll show you a calculation now for how you can do that. So let's assume that you've bought 10,000 Aussie dollar, US dollar at 73 cents. The calculation there says that we buy 10,000 Aussie dollars and we sell 7,300 US dollars. Okay. The price then moves up to 0.7301 and we want to get out. So to get out, you sell 10,000 Aussie dollars and you buy US dollars, but now you're no longer trading US dollars at 73 cents. The price has moved up to 73.01. Okay, so you're buying 73.01 US dollars with your $10,000. See, let me just bring my arrow back on here for a moment. When we bought our initial $10,000, the Aussie dollar, US dollar was trading at 73 cents. So we basically exchange our 10,000 Aussie dollars for 7,300 US dollars. Now the price has gone up to 73.01. Okay, the price has gone up to 73.01, which means one Aussie dollar buys more US dollars. So when we sell 10,000 Aussie dollars, we're selling them at the rate of 73.01 US dollars. So we're buying 73.01 US dollars. That's why there's a difference. Up the top here, buy 10,000, sell 10,000. Yeah, they cancel each other out. Sell 7,300 US dollars, okay, which is like a negative balance, negative 7,300 US dollars, and then buy 73.01 US dollars, which is like positive 7,301 US dollars. Okay, just take this off the screen. So what's the net result? You buy 10,000 Aussie dollars, you sell 10,000 Aussie dollars, you're left with 0 Aussie dollars. Okay, that one's fairly straightforward. You sell 7,300 US dollars and you buy 73.01 US dollars. What's the difference? You end up with 1 US dollar left over. Okay. What does that tell us? It tells us that a movement of 1 tick or 0.0001 is worth US $1 on the Aussie dollar, US dollar. Now, everything that you need to know about the tick value is on the screen in front of you now. Take a moment if you need to pause this recording and go through this in a little bit of detail. Just work through the steps, write them down, and then perhaps go through and try another one on maybe the British pound US dollar or the US dollar Swiss franc, and just do the calculations. Buy 10,000. What's the exchange rate? How much are you buying of currency 1? How much are you selling of currency 2? And work your way through that. Okay, it's really straightforward. You don't have to learn this maths if you don't want to. You can just accept that if you trade a $10,000 lot size, it's going to be $1 per point in currency number 2, and you can just work on it from that perspective. But it's not difficult maths, and if you spend a little bit of time with it, I admit it took me a few goes when I was learning all of this stuff, and it actually became a lot easier when I jumped in and just took a trade, as I spoke about in the previous video. But at the end of the day, that's all there is to it in terms of the mathematics. It's quite straightforward. Okay, and that's why, again, I keep bringing up this sheet. A sheet like this, you only do the calculations once, and then you write them down, and you can refer to your little table there, and you can see $10,000 in one currency means a tick value of $1 in currency number 2. Now, I was actually thinking about giving this or making the spreadsheet available. I know a lot of safety in the market students who have come to seminars already have this anyway, but I actually think it's worthwhile you spending the time to research these for yourselves. Find the code in your whatever software program you're using, whether you're using Profit Source, you can just copy these down. If you're using another program, find the different currency pairs, work out which one's currency 1, which one's currency 2, work out your position sizes, your margin, your tick size, and all these sorts of things. Okay. All right, so we've covered a lot of ground to this point, and you can see why people can struggle with FX sometimes. People come to FX and they get a little bit swamped or a little bit overwhelmed. That's why I'm just taking it nice and slowly, and we're going through everything in nitty-gritty detail here. But you can see we've covered a lot, and we've still got a few things to discuss. And one of those things, which can confuse people a little bit, is the financing. So we've mentioned that an FX transaction involves selling one currency and buying another currency. Okay. Another way of looking at that is that you're borrowing in one currency to buy another currency. And when you're doing that, that means that there are going to be borrowing costs. Okay, and here's how the borrowing costs work. You pay interest on your position size at the interest rate of the currency you sold. Okay, so remember, you're always buying one currency and selling another currency. You pay interest on the position at the interest rate of the currency you sold. Now, if you're sitting there thinking, oh, hang on, you said FX was easy to trade. Why do I have to pay for the privilege of being in an FX trade? Well, you don't always have to pay because there are two interest rates involved. You not only pay interest on your position at the interest rate of the sold currency, you receive interest on your position at the interest rate of the currency you bought. So depending on which currencies you buy and where they are in their interest rate cycles, your net financing on the position, you might pay money, you might receive money, which is called a carry trade, which I'll talk about in a couple of slides' time. Okay, so as I'm recording this in the middle of October 2018, these are the central bank rates that are used for calculating our financing on our FX trades. So you can see right at the top of the list, the US dollar, the interest rate is 2.25%. Technically, it is less than 2.25%, but for all intents and purposes, it is 2.25%. So we'll just call it that. Next is New Zealand dollar at 1.75%, Aussie dollar at 1.5%, Canadian dollar at 1.5%, pound at 0.75%, euro at 0%, and then the Japanese yen and the Swiss franc are actually at negative rates. So the Japanese yen is at negative 0.10%, and the Swiss franc, the CHF, is at negative 0.75%. Okay, what do negative interest rates mean? It means that if you buy that currency, instead of, you're still receiving interest on it, but you're receiving interest at a negative rate, which means you're paying interest. So if you were to buy any currency pair or buy that currency as part of any currency pair, you would actually be paying interest on that as well as paying interest on the currency that you've sold. The reason that some central banks have gone the negative interest rate route is that they don't want to reward people for holding their currency. They don't want speculators in there holding their currency. So they've got that. They want to devalue their currency. If speculators are going in and buying their currency, it's going to push the value of the currency up, and that can have some negative consequences for their economy, which we're going to talk about when we look at fundamental analysis in part 5 of the series. Okay, so interesting when you look at that. Remember that I said you pay interest on your position at the interest rate of the currency that you sold, and you receive interest on your position at the interest rate of the currency that you bought. Have a think about markets that you would like to, or currencies rather, that you would like to buy, and have a think about currencies that you would like to sell. Now, I'll talk about this a little bit more in a moment. You can't just buy a currency pair because of the interest rate differential, but if you've got two very similar looking trades, sometimes the currency or the interest rate differential is going to be that trigger that says, you know what, I'll take this pair instead of that pair because I'm going to get paid to be in this pair, but I have to pay to be in the other pair. Okay, that's if all else is equal. All right. Again, you don't just make a decision based on the interest rate. But if you were looking at that, the New Zealand dollar, the Australian dollar, and of course the US dollar would be the top three, and the Canadian dollar rather, top 4 currencies that you'd be more interested in buying. And then the bottom 4, you'd be more interested in selling the pound or the euro or the yen or the Swiss franc as part of your currency pair. So you can pick a currency pair that involves buying one of those top 4, selling one of those bottom 4, and the net result is you can just sit in that position and be paid interest. Okay, which is always nice, especially when it's on leverage. You can, back in the day, back 10 years ago, when you had Australian dollar interest rates up at about 7%, and you had US dollar interest rates had already come down close to 0, the yen down around 0. So you could actually buy Aussie dollars and sell either US dollars or yen and be paid 7% interest rate just for holding the position, which means if you took a $10,000 position, you make $700 a year interest on there, even though you're only putting up $50 or $100 in margin. So you can see why those trades, which were called carry trades, were actually quite popular with traders because of the interest rates. But then in 2008, 2009, we saw obviously the market's come back a long way, and any gains that you made from the interest were wiped out on the losses on the exchange rate. So again, you can't just take a trade because of the financing, but it's a little sweetener for some of the trades. So and you need to know it. You need to consider it in your calculations. So let's point out a couple. The US dollar interest rates are at 2.25%. And I've said for now because the Federal Reserve is being quite aggressive in their plan or their program of raising interest rates, which obviously President Donald Trump is not liking because he doesn't want the economy to slow down because it doesn't make him look as good, he thinks. But those rates will go up in the US. The Japanese interest rates, they've been very low for a very long time. They're currently at negative 0.10%. So let's assume you took a $10,000 long position in the US dollar against the Japanese yen. Currency one is the US dollar. You'd be receiving interest on the position at 2.25%. Currency two is the Japanese yen. And remember, you pay interest on the currency that you sold. So if we're taking a long position, we're buying currency one, which is the US dollar. So we're buying US dollars, we receive interest on those US dollars. Currency two is the yen. We're selling the yen, so we're paying interest on that currency. And you'll be paying negative 0.10% interest, which actually means you'll be receiving that interest rate. Okay? So 2.25% minus 0.1% actually is equal to 2.35%. Now, you would receive that 2.35% interest per annum on a long US dollar position, and it's calculated and paid daily. Okay, so you don't have to, it's not like a term deposit where you have to leave it. I mean, it's starting to sound pretty good, this currency gig, isn't it? You don't have to worry about, you can take $1 million position, you borrow $1 million effectively for 0.5% leverage, no stamp duty, no loan application fees, nothing like that. It's an interest-only loan. You might even get paid interest on it. And it's calculated daily. So there's no term deposit where you might have to hold it in the term deposit for 30 days or 90 days or a year. It's all calculated daily. Okay. The flip side is if you want to short the US dollar yen, you'd be paying 2.35% for that short position. All right. So an easy way of figuring it out, once you know how much you'll be paying if you're long or receiving if you're long, you just flip it around to either receiving or paying for a short position. Now, in actual fact, in practice, you don't quite get the 2.35%. The broker takes a little slice. And you've also got the overnight money market rates that move daily. So when they say interest rates are 0.25%, it's not like going to the bank and there's a board and it says interest rate is exactly 0.25% or 0.5%. The Reserve Bank or the central bank of that country is instructed to keep rates at that level through their market operations. So that rate can fluctuate ever so slightly. We're talking small decimal point moves, but it can go a tiny bit up and down depending on the supply and demand for money as well. So that rate moves slightly, but generally speaking, when you're in an FX trade, the interest positions are fairly similar every day. Okay, but that's how those interest positions are worked out. Again, though, it just goes to show the difficulty that we have in calculating a precise risk on our trade, because you can't actually say for certain you'll be receiving 2.35% because that overnight rate can move slightly and you might get a little bit more or a little bit less. Okay, so it does fluctuate a little bit, and that's completely out of your control. Once you've been trading for a while, you'll just learn to deal with it. It's not that big a deal. You just allow for it in your risk on a trade. So it's not perfect, but it is a close enough estimate. If we're looking at a $10,000 position, 10,000 US dollars multiplied by 2.35% works out at US $235. And if we convert that to a daily rate by dividing it by 365, so 1 day for every day of the year, it works out about US 64 cents per day that you'll be receiving on the trade. Okay, so if you were holding the US dollar Japanese yen in a long position, you would be holding it based on either fundamental or technical reasons that you've come to those conclusions, and we'll talk about that in part 5 of the series, but you're holding it for those reasons, and you're expecting the market to go up. And in this case, the interest is just a little bit of extra on the side that you're making. Interest is not that big a deal in the currency markets. If the exchange rates, or the interest rates rather, get too far apart and you have to pay that larger amount, it can add up a little bit, but ultimately, it's not that big a deal. And you'll notice if you're holding trades that long that you're incurring a lot of interest, you're generally holding them because it's a good trade and you're looking at a big picture chart, like a monthly chart or maybe even a quarterly chart, and you're expecting a big move, and the interest rate just becomes minuscule compared to the big move that you're hopefully going to make. So again, as I said, it's not a negative. Even if you have to pay a little bit of interest, it's not that big a deal. You'll make that back if the currency moves even a little bit. Now, you would have heard me say the word carry, or the phrase carry trade. A carry trade is when you hold an FX position purely for the interest that you'll receive. Okay, so you're not as worried if it goes up or down. You're holding it mainly for the interest. Okay, an example is if you were buying the US dollar against the Swiss franc. We saw US interest rates at 2.25% and Swiss franc interest rates at negative 0.75%. Okay, so you'd be paying negative 0.75%. In actual fact, you'd be receiving 75.75%, and that adds up to a total of plus 3% just for holding that currency. That would be a carry trade if you decided, I'm just going to buy this and hold it for the interest. Okay, so let's do a calculation quickly. Imagine that you've put up $1,000 margin into your account and you've taken a $10,000 position. And you're going to be paid 3% interest on that US dollar Swiss franc deal on the $10,000. Even though you've only put $1,000 margin up, you're still getting 3% on the position size, not on your money in the account, on the position size. So you'll earn $300 over the course of a year, and you've only put $1,000 into your account. That's the equivalent of earning 30% per annum there. Okay. Now, that sounds like a pretty sweet deal. And if you multiply the numbers out and you take $1 million position, if you're earning 30% on $1 million, that's $30,000 a year just in interest, just for holding a position. And you can put a stop loss on the position too, so that you're not going to lose any money. That's a pretty good deal, okay? But you have to hold the position for a whole year to earn that amount, okay? To earn that whole $300. Now, you can hold it for a day and get paid a day's interest. You can hold it for a week and get a week's interest. But as soon as you close the position, that's it. You stop earning the interest on there, okay? With that said, I know it sounds tempting and you might be already doing calculations in your head saying, gee, if I could just buy US dollar Swiss franc and that's 3%, and if I bought $3 million worth, I'd be earning $90,000 a year and then I can retire. Just remember that if the trade moves against you, you're going to lose a lot more than you make in terms of interest, okay? And that's a good way to a good segue into our calculating risk and reward slides. We're coming to the end of the presentation now, but this is where it gets really serious. It's okay if you understand position size and tick value, you can be an expert in all of that. But if you get the risk and reward calculations wrong, you can still do some serious damage to your account. So make sure you understand. Don't worry about the reward. If you can work out the risk, everything else will take care of itself. Just manage your risk on a trade. Now, it's slightly trickier on currencies than it is on stocks because there are two exchange rates. There's the exchange rate when you get in and the exchange rate when you get out. Okay, so as an example, if you were to buy, say, ANZ shares here in Australia, if you bought 100 of them at $25 each, you'd be outlaying $2,500. If the share price goes up by 10%, your position goes up by 10%. So it's now worth $2,750. You've got a profit of $250, which is 10% of your position size. Now, you might be thinking, well, this is just really simple maths. Why are you wasting my time with this? But there is a point here. If the share price had fallen 10%, your position would only be worth $22.50. You would lose $250, so you would lose 10% of your position size. But see, all the way through there, 10%, 10%, 10%, 10%. It all adds up. It's all easy to calculate there. There's only the one exchange rate. Well, there's no exchange rate. You're buying shares in Australian dollars and you're getting paid in Australian dollars, or you're losing money in Australian dollars. It's a little bit trickier though when you start doing this with currencies. So if you buy 10,000 Aussie dollar US dollar and it's trading at 70 cents, the tick value is going to be $1 US per point. If the price goes up by 10%, the currency is now worth 0.7700. Okay, so if you think about it, 7,000 up the top there, we'll just remove the decimal places. The Aussie dollar was trading at 7,000. Add 10%, you get up to 7,700. How much money have you made? You've made a gain of 700 points. At $1 US each, that means you've made US $700. If the price falls 10% to 63 cents, you had a loss of 700 points, which means a loss of 700 US dollars. Now, you might be saying, what's the problem? I can see 10% rise, 10% fall, and the same dollar amount, 700 US dollars minus US $700. What's the difficult part? It's the same thing, right? Well, actually, no, it's not. It's very different. And the reason it's different is that you're converting the $700 back to Australian dollars at a different exchange rate. Now, I'm going to show you this on the next slide, but basically, if you've had this gain of 700 points, you're converting that US $700 when the exchange rate is at 0.77. So you're converting those US dollars into Aussie dollars when one Aussie dollar buys 77 US cents. If you've had a loss of 700, it's because the price has gone down to 0.6300. You've got to convert your loss into Australian dollars at an exchange rate of 0.6300. So they're going to be converted into Australian dollars at two different rates, which means they cannot be the same dollar or loss. It's going to be different. Okay, so let's jump onto the next slide now and see how that works. That US 700 needs to be converted into the base currency for your trading account. So you made 700 US dollars when the Aussie dollar exchange rate was up to 7,700. If we convert the $700 into Australian dollars at an exchange rate of 0.7700, and you can see how I do that, $700 divided by 0.77 equals 909 Australian dollars and 9 cents. If you're not sure how to do that, you're basically either multiplying or dividing by the exchange rate. Just make sure that you know that if US $700, you know it's going to be more Australian dollars because one Aussie dollar only buys 0.77. Okay, it's just simple mathematics. You just write the equation out and you can work that out. If you lost $700 when the Aussie dollar exchange rate went down to 63 cents and you're converting that at 63 cents, your actual loss is $1,111.11 in Australian dollars. Okay, so that's the key point to take away from all of this. It's that different amount. When you're converting $700 at 0.77, it converts to 909 Australian dollars. When you're converting it at 63 cents, it converts to 1,111 Australian dollars. Okay, big difference there. It's $202 difference between those two amounts, even though it was a 10% move up and a 10% move down. So what does that tell us? It means that we need to be aware that we're going to be exiting. If we're wrong and we get stopped out for a loss, we're going to be out of the market at a particular exchange rate. But if we're right and the market moves in our favor, when we take our profits, that profit is going to be at a different exchange rate. Okay, so basically, when you set your reward and your risk up, you have to just be aware of the exchange rate that you expect you'll be exiting at, and you can calculate that. The most important part there is that you get the risk part right. If you get the risk part right, everything else is going to be fine. Okay, so let's have a look. So hopefully you can see the difference there. If not, just pause this and go through it again and do those calculations for yourself. Now, when we calculate risk and reward, remember there's always the two currencies involved, which are currency 1 and currency 2. But remember I said earlier, sometimes there is a currency number 3. And that currency 3 is the currency that your trading account is denominated in. If you're trading the euro against the US dollar, but your account is denominated in Australian dollars, you're going to need to convert your profits and losses into Australian dollars. Brokers will generally do that automatically for you, but as I said, there is going to be that slight discrepancy when that account or when that transaction occurs. So how do we calculate our risk? At Safety in the Market, we use a calculation entry minus stop loss to work out our risk in terms of ticks. Okay? If you've got the active trader program, in the Smarter Starter Pack, there's a brilliant example on trading the euro, and you can go through a whole series of trades using swing charts on the euro, and you can see all of the calculations listed out for you. If you're trying to learn how to trade currencies, there's a great place to start if you're an existing Safety in the Market student. If you're not a Safety in the Market student and you'd like to be, just drop us an email at info@safetyinthemarket.com.au, and we can give you some information on how you can get started with us. But our calculation there, entry minus stop loss equals our risk in terms of ticks. Okay. So for example, let's say that we're getting into the market at a price of 71.50, and we put a stop loss at 7100. We take one from the other, and we see the difference between those is 50 ticks. That means that if we get into this market and we're wrong and it falls and kicks us out, we're going to be risking 50 ticks. Ordinarily, I base my entry and my stop loss on important pressure points in the markets using swing charts. So I have set points. I don't go in and say I'm risking 50 ticks on this trade. I will go in and say, here's my entry point. Here's where I'm going to put a stop loss in case I'm wrong. So my risk will be 50 ticks or 60 ticks or 70 ticks, for example. In the FX markets, you're generally looking at somewhere between 50 to 100 ticks risk on a trade if you're trading on an end of day basis. If you're trading on an intraday basis, that risk will be a lot smaller, but it's a lot more work intensive as well. So let's say we've done this calculation and we know that we're risking 50 ticks on the trade. What does that equate to? Well, we don't know because we don't have a position size worked out yet. So assume that you're risking 50 ticks. If you were to take this 50 tick risk with a $10,000 position, it's going to be worth US $50. Okay, so if we're setting up this trade where we're buying at 71.50 and we've got a stop loss at 7100, we've got 50 ticks of risk. If we take a $10,000 position and we're wrong, we lose $50. Now, you might be saying, but I don't want to lose $50. I only want to lose $25, for example. Well, you'd have to take a smaller position. Now, $10,000 is the smallest position that most brokers will let you take, so you probably let that trade go. But what if you're looking at this the other way? What if you don't want to risk $50? What if you want to risk $350? How are you going to set that up? Okay, I want you to think about that for a moment. If I'm taking a 10,000 Aussie dollar US dollar position, I'm risking 50 US dollars. I've done the maths and that's what I've worked out. What if I want to risk $350? Now, there are two ways we can do this. There's the fast way and there's the slow way. Okay, the slow way is to say $10,000 means I'm risking $50. Therefore, if a $20,000 position would be risking $100, a $30,000 position, I'd be risking $150, and you keep going up slowly that way until you hit $350 risk. Or you can take the amount that you want to risk, which is $350, and divide it by the amount that you're risking for a $10,000 position, which is $50, and you divide 350 by 50, you come up with 7. And that means that you can take 7 $10,000 positions, or an easier way of looking at that is it's a $70,000 position. Okay, so 7 times $10,000 equals $70,000. So if you were to take a 70,000 Aussie dollar US dollar position, you'd be risking $350 on that trade. Okay, so the important steps there that you can see: work out how many ticks you're risking on the trade, work out the amount of dollars that you'll be risking on a $10,000 position, and then convert that into whatever risk you want. Okay, if you want to risk $350, that becomes a $70,000 position. Okay, so those are the important steps there. And again, this might be a good one to just pause and work through step by step, and maybe jump into your trading software and find an example that you'd like to trade and work out the risk on that as well. Now, if you're a safety in the market student, remember you've got our trading support service, so you can just email the trading support service, and you can send them an email that says, hey, look, I'm trying to learn this FX stuff off the YouTube video. Here's my calculation. Is that correct? Now, do it on an old trade from the past. They're not going to tell you a live trade that's working now, but just show them the calculation and they'll check the maths for you and make sure that you understand that. Alternatively, you can also go to your broker and they can help you out with that as well. Okay, so let's calculate the dollar amount of a trade in terms of risk at the exchange rate of your stop loss and reward at the exchange rate of your target. They are the two steps when you are going to jump into a trade to make sure that that trade is going to be worth your while. Okay, so what that means is on an ordinary stock trade, you work out how much you're risking if you're wrong and how much you're going to make if you're right. Okay, but there's one extra step here for the currency markets, and that's you work out your risk. So it might be 50 ticks or 100 ticks, but you calculate that at the exchange rate of your stop loss. So if the market moves against you, you'll be exiting that position at the price, at the exchange rate of your stop loss. It's a little bit trickier if you're dealing with three currencies. So if you're trading Euro, US dollars, but your account's in Australian dollars, you're going to have to convert those US dollars into Australian dollars, and you're going to have to estimate what that rate is. Okay, so it's a little bit fiddly there. And then you've got your reward there, which is at the exchange rate of your target, and they can be two very different figures, or they should be two very different figures. Okay, so keep that in mind when you're working out your reward and your risk. It sounds complicated, but as you'll see in the next video, it's actually really straightforward. And when you've done 2 or 3 of them, it gets a lot quicker and easier, and it all makes sense. Okay. When you do these calculations, ensure that your dollar reward is at least 3 times your dollars risked. Okay. Now, you might be thinking, well, I'm risking 50 ticks and I'm making 150 ticks if I'm right. Therefore, my ticks are 3 times the size of my risk. But remember that you've got the exchange rate factor in there. It's not enough to just have a 3-to-1 reward to risk ratio in terms of ticks. Make sure that the dollars that you're going to be making are at least 3 times the dollars that you're going to be risking. Okay. By the end of this 7-part series, we'll have done a number of these examples and you'll see them all the way through in full. I know it is a little bit heavy at times, okay, but you've got to do the heavy work here in video 2 to get you through the later videos. And as I said, we'll be doing a lot more on this risk and reward stuff and a lot more calculations in video 4 when we look at account management and position sizing. Okay. Also, estimate the interest that you're going to be paid, that you are going to be paying or receiving on the trade. And this is an interesting one. If I am going to receive interest on a trade, I treat it as just a part of my reward. I don't factor it into my calculations. I just treat it as a little bit of a bonus reward. However, if I'm going to have to pay interest on the trade, I'll estimate I'm going to be in this trade for 14 days or 30 days or 50 days, and I'll calculate that amount of interest and I'll include that in my risk. So in other words, if I'm going to be risking, say, $1,000 on a trade, and I think I'm going to have to pay $100 in interest while I'm in that trade, I'll set up my risk on the rest of the trade to just be $900 risk, and I'll include that interest of $100 as part of my risk. Okay. Again, we're going to talk about this in later videos as we go through examples, but that's how I treat that. If I'm receiving interest, it's a bonus. If I have to pay interest, I treat that as part of my risk. If you've got a $10,000 account and you're risking 5% on each trade, which is $500, it's not $500 risk plus interest paid. It's $500 total, which is $500 for your risk on the trade, any brokerage or commission, and any interest as well. So keep all of that in mind. Okay. Now, we've covered a ton of ground here. All right, we've covered a lot of stuff. Obviously, you may need to go back and watch some or all of this video again to absorb these things, but And also keep in mind, this is only part 2 of 7. But as I did say at the beginning, once you understand each of these individual parts, you can go away and take a trade. Okay, you can jump in, open up a demonstration account, jump in and take a trade and give it a crack and see what happens, and test your understanding of what we've discussed here today in this video. But there is a little bit more to go through. As I said, we're going to be looking in a bit more detail into things like account management. Next video, we're going to be looking at a demo account and taking a live trade and seeing it all unfold in real time. We've got to look at fundamental and technical analysis. We've got to look at lessons from history. And we also are going to look at a case study where we set up for an FX trade from start to finish. And that's all coming up in video 7. Okay. Now, you may need to watch this more than once, as I said. Feel free to do that. Maybe you just need to watch one section again, so you can obviously flick through that just to that section that you need. Okay. But as I said, you now know enough to go and trade FX with the information that you've got in this video. But make sure you do it with safety. And if you've never traded FX before, please consider doing it for the first time in a demo account or a virtual account, so you're not actually risking real money. Okay. If you enjoyed the video, please click on the like button below, which is the thumbs up icon. We'd appreciate a thumbs up. We'd also appreciate if you subscribe to the channel if you haven't already, and that's going to help keep you up to date with all of our future videos as they're released. So please subscribe, as I said, if you haven't already done so. You can only subscribe once if you're new to YouTube, so please, if you've done it once, you don't need to do it again. So coming up next, obviously part 3, we're going to be looking at taking an FX trade. Part 4 will be going into a lot more detail in account management and position sizing and making sure that you're taking appropriate risks that are big enough but not too big. Okay, there's no point doing all of this to risk $5 on a trade. You're not going to replace your income risking $5 on a trade. Part 5, we're going to be looking at fundamental and technical analysis. Part 6, we'll look at lessons from history. And in part 7, we'll bring everything together and set up for an FX trade. Thanks for joining us for the video. I know it was a long one and a little bit challenging. I hope you got plenty out of it. Keep an eye out for part 3 coming to you soon. Again, if you haven't already subscribed, please subscribe. Thanks for watching, and I'll see you in the next video.